Hey everyone, and welcome back to the Safe, Simple Sound podcast, Tax Edition. I'm your host, Alex. Thanks for tuning in. We know that managing finances can feel like navigating a maze, and for families supporting loved ones with special needs, that maze can often feel even more complex, with unique costs and considerations. Today, we're tackling a topic that sits right at the intersection of family care and financial well-being: tax deductions for special needs families here in the U.S. Our discussion is informed by a really helpful guide that breaks down how to approach these deductions, referencing key information directly from IRS resources like Publication 17, and perhaps more importantly for this topic, Publication 502. This guide really drove home a couple of key points for me. First, just how critical the decision between taking the standard deduction versus itemizing can be for families facing significant disability-related expenses. And second, while the tax code might not have one giant special needs deduction category, there are several specific areas, like medical expenses and even certain work-related costs, where significant savings might be found if you know where to look and how the rules apply. Making these informed choices is a huge part of seizing financial control, one of our core beliefs here at Safe Simple Sound. So understanding these disability tax deductions is key to potentially lowering your tax bill and freeing up resources for your family. It's about making sound financial decisions based on understanding your choices. Our goal today is to provide clear, practical insights to help you navigate this aspect of your financial journey with more confidence. Ready to dive in and get tax savvy? Let's get started. We know that raising a family is a huge undertaking, and for families with special needs, the financial demands can be significantly higher. Therapies, specialized equipment, medical care, educational support, the list goes on. It's a lot, but the good news is the tax system can offer some potential relief, and understanding how is key. So first, let's tackle segment 1, the big decision: standard versus itemized deductions. This is a fundamental choice every taxpayer faces, but it holds particular importance for our listeners. At its core, when you file your taxes, you have a choice to reduce your taxable income. Option 1 is the standard deduction. Think of it like a flat discount the government gives you. It's a fixed amount, determined primarily by your filing status, like single, married filing jointly, head of household, and there are slightly higher amounts if you or your spouse are over 65 or blind. It's simple, straightforward, no fuss. Now, that filing status piece is important. How does your filing status influence the standard deduction amount you need to beat? Well, the amount for married filing jointly is much higher than for single, for instance. Knowing your specific standard deduction amount is crucial for this whole decision. Option 2 is itemizing deductions. Instead of that flat discount, you tally up specific eligible expenses you paid during the year. Things like certain state and local taxes, home mortgage interest, charitable donations, and importantly, for many of our listeners, medical expenses. You list these out on what's called Schedule A of your tax return. So, why does digging into itemizing matter so much? Here's the key. Those significant costs we mentioned earlier, the therapies, doctor visits, specialized equipment, maybe even travel for medical care, these can add up fast. For many families, these costs, when combined with other potential deductions like mortgage interest or state taxes, might push your total above that fixed standard deduction amount. When you itemize and your total itemized deductions are greater than the standard deduction, you get to deduct the larger amount. This means a lower taxable income, which usually translates to owing less tax or getting a larger refund. Understanding potential itemized deductions special needs families might have is really powerful here. Let me ask you this, just to get you thinking. Looking back at last year's expenses related to special needs care, do you think they might have pushed you close to or over the standard deduction threshold for your filing status? Just ballpark it in your head. Were those medical and related costs substantial? Getting a handle on this choice, standard versus itemized, is truly the foundational first step in strategic tax planning. Special needs families should consider every single year. Your situation can change, deduction amounts change, so it's always worth a fresh look. So, if you're wondering whether itemizing might be for you, What are the immediate steps you can take to start estimating? It doesn't have to be perfect right now, just a rough idea. And just a little heads up before we move on. How you claim dependents, particularly dependents with special needs, can also significantly impact other tax credits and benefits. We're going to dedicate more time to that in a later segment, but it definitely ties into this overall tax picture. Okay, so the big takeaway today is understanding this crucial fork in the road. Take the simple, fixed standard deduction, or potentially lower your tax bill further by itemizing your specific expenses if they add up to more, which is often driven by those significant special needs related costs. Ready for a small action step? Here it is. Find out the current year's standard deduction amount specifically for your filing status. Just search online for IRS standard deduction. Then take maybe 10-15 minutes and jot down some rough estimates of your potential itemized deductions. Think big categories. How much did you pay in qualifying medical expenses last year? How much in state and local taxes? How much in home mortgage interest? Add those up. Does that rough total look like it might beat your standard deduction? This quick check will tell you if digging deeper into itemizing is worth your time. Doing that quick estimate is the perfect setup for our next segment. Now that we understand why itemizing can be so beneficial, we're going to zoom in on arguably the most significant category for many special needs families: unlocking medical expense deductions. We'll talk about what counts, the tricky AGI threshold, and even how certain special education costs might fit in, guided by the all-important IRS Publication 502. So next, in segment 2, we're diving deep into what is often the biggest piece of that itemizing puzzle for families like yours: unlocking medical expense deductions. And we'll even touch on how special education costs can sometimes fit in here. Now, this is potentially huge. When we talk about the medical expense deduction, disability-related costs often represent, we're talking about what could be your single largest itemized deduction. As many of you know firsthand, the costs associated with therapies, treatments, equipment, and specialized care add up incredibly fast. Being able to deduct a portion of these expenses can provide some very real financial relief come tax time. But here's the first crucial thing you need to know, and maybe grab a pen or open a note on your phone for this. The detailed, nitty-gritty rules for these deductions are not primarily found in the General IRS Guide, Publication 17. You need a specific resource: IRS Publication 502, Medical and Dental Expenses. That's Publication 502. This is your go-to guide for figuring out what qualifies. Seriously, bookmark it, download it, it's essential. Okay, now for probably the most important rule, and it can feel like a bit of a hurdle. You can only deduct the amount of qualified medical expenses that exceeds a certain percentage of your adjusted gross income, or AGI. Let me repeat that. It's the amount over a specific AGI percentage. Think of it like a deductible on an insurance policy. You have to cover the first portion yourself before the benefit kicks in. This AGI threshold is critical. It means not every dollar you spend will be deductible, only the amount above that threshold. We won't get into the exact percentage today as it can change, but checking IRS Publication 502 will give you the current number. So, what kind of expenses are we talking about that could potentially count towards hitting and exceeding that threshold? Well, Publication 502 covers a lot, but think about costs for diagnosing a condition, treatments, including therapies like physical, occupational, or speech therapy, mitigating a disability. This can include things like specialized equipment, adaptive devices, even guide dogs. Certain travel costs primarily for and essential to medical care, like mileage to therapy appointments or specific clinics. Even home modifications, if they are medically necessary. Think ramps, grab bars, maybe modifying a bathroom. Again, the details are in Pub 502. Now, a question I get a lot is about special education costs. Can you deduct private school tuition if your child has special needs? Under certain strict conditions, tuition for special education might be deductible, but it's treated as a medical expense, not an education expense. The key, according to IRS Publication 502, is that the primary reason for attending the school must be to overcome learning disabilities caused by a mental or physical impairment, And this placement needs to be recommended by a physician. It's not just about finding a better educational environment. It has to be primarily therapeutic or medical in nature, as defined by the IRS. So documentation like that doctor's recommendation is absolutely essential. So take a moment now and just reflect. Think about the past year. What types of medical, therapeutic, or specialized equipment costs have you incurred for your family member? Start making a mental list, or better yet, jot them down later. Were there travel costs? Special dietary needs prescribed by a doctor? These could all potentially count. Okay, let's quickly recap the big takeaways for medical expense deductions. 1. This can be a significant medical expense deduction. Disability-related costs often drive, potentially, your largest itemized deduction. 2. Your main resource is IRS Publication 502, not the general guides. 3. Remember the AGI threshold. You only deduct expenses exceeding a percentage of your income. 4. A wide range of costs might qualify, including therapies, equipment, and sometimes even special education if it meets strict medical criteria. This brings us to your action step for this segment. It's straightforward but so important. Download or bookmark IRS Publication 502. Get familiar with it. And second, start a dedicated system now to track all potential medical and disability-related expenses. Whether it's a simple spreadsheet, a dedicated folder for receipts, or an app, doesn't matter. Just start tracking consistently throughout the year. Keep receipts, invoices, mileage logs, and any doctor's notes related to these costs. Doing this groundwork makes calculating your potential deduction much easier and ensures you have the proof you need if you itemize. We dove deep into medical expense deductions, particularly looking at how things like therapy or even specialized schooling might qualify under those tricky AGI thresholds, all detailed in IRS Publication 502. That's about costs often related to treating or managing a condition. But now, let's shift gears to a different and really important category of potential disability tax deductions. Expenses that aren't about treatment, but about enabling someone to work. Next, in Segment 3, our specific deduction focus is on something called Impairment-Related Work Expenses, or IRWEs. That's IRWE. These are specific costs that allow an individual who has a physical or mental disability to actually perform their job. Think of it this way. These aren't costs to fix the disability, but costs incurred specifically to bridge the gap and allow someone to work effectively despite the challenges their disability might present. So, who can claim these? This deduction applies directly to individuals with disabilities who are incurring these costs to maintain their employment. This could be you or perhaps an adult dependent you support, and it covers both traditional employees and self-employed individuals. So whether you get a W-2 or run your own business via Schedule C or F, if you have a disability and pay for things specifically to help you work, this is relevant to you. Let's talk examples of IRWEs because that makes it much clearer. We're talking about real, tangible costs. For instance, maybe someone needs attendant care services, but specifically at their workplace to help with tasks like retrieving files, reading print, or personal care during work hours. Or think about specialized software. Maybe screen reader software for someone visually impaired, or voice recognition software for someone with a physical limitation affecting typing. Other examples could include the cost of reader services if you're blind and need someone to read work documents to you, or paying for sign language interpreters for work-related meetings if you are deaf or hard of hearing. It really comes down to this question. If you or an adult dependent with a disability are employed or self-employed, what specific, unreimbursed costs are directly related to managing the disability in order to work? What do you need to pay for, out of pocket, just to be able to do your job effectively because of your impairment? Now, how does the deduction mechanics work? It's a little different depending on your employment status. If you're an employee, these impairment-related work expenses are claimed as itemized deductions special needs individuals might list on Schedule A of your Form 1040. Here's a key point. Unlike some older miscellaneous deductions, these IRWEs are not subject to that old 2% of adjusted gross income floor. That's good news. If you're self-employed, you'd typically deduct these expenses directly on your business schedule, like Schedule C for sole proprietors, Schedule E for rental royalty income, or Schedule F for farmers. It becomes a direct business expense related to earning your income. But like all deductions, there are key criteria you absolutely must meet. The IRS is specific here. These expenses must be 1. Unreimbursed. Your employer, insurance, or vocational rehab didn't pay you back for them. 2. Necessary for work. You need the expense specifically to be able to perform your job duties. 3. Attributable to the disability. The cost wouldn't exist if not for your physical or mental disability. 4. Ordinary and necessary business expenses. This is standard IRS language. Ordinary means it's common or accepted in your field, and necessary means it's helpful and appropriate for your job or business. This brings up a couple of important reflection points. First, how can you clearly document that these expenses are ordinary and necessary for your specific job or business function? Keeping detailed records is vital. Invoices, notes explaining why the service or item was needed for work, maybe even a letter from your doctor linking the need to your disability and work tasks. Second, what's the difference between a medical expense related to the disability versus an expense specifically enabling work performance? This can be tricky. A hearing aid is generally a medical expense, but paying an interpreter to attend a mandatory work conference because you are deaf? That sounds much more like an IRB. It's directly enabling work performance. It's about the purpose of the expense. So to recap this segment on impairment-related work expenses, these are costs for individuals with disabilities needed specifically to work. They apply to both employees and self-employed individuals. Examples include attendant care at work, specialized software, readers, or interpreters needed for the job. Crucially, they must be unreimbursed, necessary for work directly related to the disability, and meet the ordinary and necessary test. Okay, here's your action step for this segment. If this situation applies to you or an adult dependent you support, take some time to review any work-related expenses you've incurred. Do they seem to fit the criteria for impairment-related work expenses? Your best resources for the nitty-gritty details are IRS Publication 907, that's Pub 907, and the instructions for Schedule A. Dig into those if you think this valuable deduction might apply to your situation. Phew! We've covered the standard versus itemized decision, deep dived into medical expenses, and now explored these specific work-related deductions. But knowing about these deductions is one thing. Fitting them into an overall financial picture is another. In our next segment, we'll zoom out a bit. We'll talk about smart tax planning. Special needs families can use year-round, the importance of record keeping, briefly touch on ABLE accounts, and point you towards where you can find reliable tax help. Stay with us on Safe, Simple, Sound. Think of the deductions we've discussed, like medical expenses or IRWEs, as individual puzzle pieces. Now, we're going to look at how to build the whole picture strategically. This segment is all about smart tax planning, ABLE accounts, and finding help. First things first, let's talk strategy. Effective tax planning special needs families can really benefit from isn't just a mad dash in April. It's a year-round mindset. Trying to piece everything together just before the tax deadline is like trying to cram for a final exam the night before. Stressful, and you're bound to miss things. True tax planning, especially with the complexities that can come with special needs, means thinking about it throughout the year. It's about being proactive, not reactive. And what's the cornerstone of that proactive approach? Record keeping is king. I cannot stress this enough. Imagine trying to build a legal case without any evidence. You wouldn't get far, right? It's the same with taxes, especially when claiming deductions. You need meticulous records, receipts for therapies, invoices for equipment, doctor's notes recommending specific treatments or educational settings, even mileage logs for medical travel. Every piece of paper helps substantiate your claims if the IRS ever asks. This is particularly vital for those potentially large medical expense deductions we covered in Segment 2. Now, building on that idea of proactive financial management, let's introduce a powerful tool that often works alongside tax deductions: ABLE accounts. You won't find details on these in the General IRS Publication 17 we referenced earlier, but they are crucial. ABLE stands for Achieving a Better Life Experience. These are specialized tax-advantaged savings accounts for eligible individuals who became disabled before age 26. Think of them like a 529 plan, but for disability-related expenses. The big advantage with ABLE accounts tax benefits is that the money grows tax-free, and withdrawals are also tax-free when used for qualified disability expenses. Things like housing, education, transportation, assistive technology, and so much more. It's a fantastic way to save for future needs without impacting eligibility for certain government benefits, up to certain limits. It complements your tax deduction strategy by providing a separate vehicle for savings and tax-free spending on qualified expenses. Okay, another layer of complexity we need to touch on briefly involves dependent rules. Especially if you're caring for older children or adult dependents with disabilities, understanding who qualifies as your dependent is critical. The rules can be nuanced. Check out IRS Publication 501 for the details. Getting this right is key because claiming a dependent, particularly one with a disability who might meet different tests regardless of age, can unlock eligibility for other valuable tax credits and benefits beyond just deductions. So, we've covered strategy, record keeping, ABLE accounts, and dependent rules. Feeling a bit overwhelmed? That's perfectly normal. Which brings us to our next point. Remember your resources. The IRS website, irs.gov, is your go-to hub. We've mentioned specific publications like Pub 501 for dependents, Pub 502 for medical expenses, and Pub 907 for tax highlights for persons with disabilities. Bookmark these. And don't forget, there's free tax help special needs families might be able to access through programs like VITA and TCE. They offer free basic tax return preparation for qualified individuals. Finally, know when to call in the pros. While resources like VITA TCE are fantastic, sometimes your situation might require more specialized knowledge. If your tax situation is complex, maybe involving multiple income streams, business ownership, significant assets, or particularly tricky dependent or medical expense scenarios, consulting a qualified tax professional who is specifically familiar with disability-related tax issues is often a wise investment. They can provide personalized advice tailored to your unique circumstances. Now, let's pause and reflect for a moment. Thinking about your own situation, what is one concrete step you can take this week to improve your system for tracking disability-related expenses? Maybe it's creating that dedicated spreadsheet or just putting a labeled folder by the door for receipts. How might an ABLE account fit into your family's bigger financial picture, working alongside tax deductions? And thinking about getting help. When does it feel right to use a free service like VITA or TCE versus seeking out a paid, specialized tax professional? Consider your own comfort level and the complexity of your return. Okay, let's wrap up this segment. Key takeaways. Tax planning is a marathon, not a sprint. Do it year-round. Your records are your proof. Track everything meticulously. Explore ABLE accounts as a powerful savings tool with tax advantages. Understand the nuances of dependent rules. And finally, use the excellent resources available, including free tax help or a specialized professional when needed. So, here's your action step for this segment. First, take 5 minutes this week to review your current expense tracking method and make just one improvement. Maybe it's downloading a tracking app, setting up that spreadsheet, or clearing out a dedicated box for receipts. Second, open your web browser and explore your specific state's ABLE program website. Just search for ABLE program. See what it offers. Third, bookmark irs.gov/VITA so you can easily find free tax help resources if that feels like the right fit for you. Taking these small, proactive steps can make a huge difference in managing your finances and reducing tax season stress. And that wraps up our deep dive into navigating tax deductions special needs families should be aware of here in the U.S. We covered quite a bit today, from understanding that fundamental choice between the standard deduction versus itemized deductions special needs costs might justify, right through to specific areas like the crucial medical expense deduction disability-related costs can often fall under. Remember, the key takeaway here is that while the tax code can seem intimidating, understanding specific provisions can lead to real savings. We explored how IRS Publication 502 is absolutely vital for those medical expenses, discussed impairment-related work expenses, and emphasized the power of year-round tax planning. Special needs families can implement. Simple things like meticulous record keeping make a huge difference. We also briefly touched on tools like ABLE accounts, tax benefits, and where to find reliable tax help special needs families can turn to. I really hope this discussion empowers you to look at your own situation and see where these disability tax deductions might apply. It's all about making sound financial decisions based on understanding your options, making a complex topic hopefully feel a bit more simple, and ultimately helping you seize financial control. Thank you so much for joining me today on the Safe, Simple, Sound podcast. I truly appreciate you spending your valuable time with us. Remember, knowledge is power when it comes to your finances. Keep seeking out that understanding to make sound choices simple. Until next time, take care. This is Alex from the Safe, Simple, Sound podcast, signing off.